Hi, everyone. I'm back with my quarterly discussion with our Chief Investment Strategist, Philip Petursson. And Philip, thank you again very much for your time because I know you're a very busy man. Um, so I wanted to quickly ask you, though, before we really get going, and I give you a word in, is I've used the term chief investment strategist many times, and I've really thrown it around a lot, not only with our clients, but also, when I'm doing videos for clients. But I don't think I've ever actually asked you, what is a chief investment strategist and where is your role? Can you help describe that?
Yeah, certainly. It's a role where what we are trying to do is to put together the narrative on what we should be looking at with respect to the investment environment, the economic environment that we're in right now, and where we're headed over the course of the next, say, 12 to 18 months, and how we should be positioned within our portfolios. And so that's what the kind of the general driver of the position is. If you ask me, well, what is a typical day for me? It's I get up in the morning, open up the Bloomberg, update my spreadsheets and my models, look at the economic releases of the day. If we're in earnings season, follow along with what the companies are saying, all with the objective of trying to identify some of the risks and the opportunities within the marketplace, and then through some of our portfolios, position accordingly for that.
Yeah, it's really interesting that you used the word risk and opportunity because I think a lot of clients don't really see that together. And one of the things that we always talk about in any investment environment is risk can actually be your friend, right? So opportunities always exist whenever we're looking on global parameters. And maybe if I could have you talk a little bit about just really the economic landscape, I would say, in the markets that we would understand. Let's say, the westernized markets or developed markets.
Yeah, and there I would say it depends on the area that you're looking at, where we are within the economic cycle. And so different areas are further along in the economic cycle than others. And so I would say let's start in Canada, right? This is near and dear to everyone. I would argue that Canada is in a recession at this point. If you look at the economic data, we've had 4 months essentially of flat GDP growth. So the economy hasn't grown in the last 4 months. And I think that's what we're going to see over the next couple of months with perhaps a modest contraction. So very recession-like conditions. If you look at retail sales as well in Canada, they're down year over year. And this is all coming, I would say, driven by interest rate policy, which has been trying to get inflation under control, meaning the Bank of Canada has been raising interest rates to keep inflation low. But as they raise interest rates, it raises the costs of our mortgages. It raises the costs of any debt that we have. And that has been a burden on the Canadian consumer and has led us to where we are in the economic cycle. And so again, I say recession. For most people, it doesn't feel like it because the I would say the good news is that the labor market is very strong. So unemployment remains relatively low or very low in this country. So economically, we see a recession, but it doesn't feel like it at the home front. When we look at other areas around the world, the US, for example, they're still, I would say they're not in a recession. Are they headed towards one? Well, we're always headed towards the next one, but is it 3 months or is it 3 years? It's probably closer than further away. And there are some signs of economic weakness in the US, but in general, the economy is doing fairly well. Then we go to Europe, and Europe has been in a recession probably for the last couple of quarters. They're further along in terms of their economic cycle. They're about to, we would say, over the course of the next 12 months, break through and start to see a recovery and expansion again. So, where are we in the world and from the economic cycle? It depends where you're standing.
Yeah, excellent. And again, all of it from your perspective, really from our perspective, our job is to help identify great opportunities around the world and also to help manage the risk in that environment, of course. Right. So based upon that and what you said, maybe tell me a little bit about where you're feeling some optimism or really where you think the portfolios should continue to shift towards to help not only protect, but also to help provide long-term growth.
Well, Rod, when you mentioned risk earlier and you said, risk isn't necessarily always in one direction, it's true. There's risk to the downside. We immediately think of risk as loss, but there's also risk to the upside, which is better than expected gains. And we've seen that in I would say, again, different markets. In the United States, we've had that risk to the upside where the equity has well this year at the index level. But when you go a little bit deeper into it, it's really 7 stocks that have been driving the bulk of the gains. When you strip out those 7 stocks from the rest of the market, it's essentially flat on the year, which in this kind of economic environment that we're in makes sense. But when we think about the opportunities, one of the benefits of this higher interest rate environment that we've kind of lived through over the last year and change is that we are now seeing much higher interest rates offered on bonds and other interest-bearing vehicles. And so we have, for example, looking at the US 10-year Treasury yield, that's at 4.5% today. We haven't seen that in 20 years. So that's a very attractive yield being offered with inflation that's running between 3 and 3.5%. So you have a positive return out of bonds. If you look at corporate bonds, there it's about 5.5, 6%. High yield bonds a little bit better than that. So bonds are very attractive, and they offer good downside protection in the event of equity market volatility. And so how we're thinking about portfolios today is steering towards the areas that offer decent upside with limited downside, that's fixed income. And then within the equity markets overall, we've been underweight the US because the US equity market is, we would call, fully valued. It's not cheap versus being overweight Canada that should benefit from oil prices now being through $90 a barrel media, as well as the rest of the world that is significantly cheap, or very attractively valued, where we would argue that the worst of the economic environment is already reflected in the price of stocks outside of North America. And therefore, anything better or any improvement should result in upside risk or upside benefit with respect to owning international equities.
Yeah, it's interesting, Philip, thank you for that, by the way. I can't remember. I actually looked at how many economic cycles I've been through in recessionary periods, and it's many, and they all feel and taste the same. And one of the aspects of that too is that there's a disconnect between what's really happening in the economy and what consumers are feeling, and particularly in the news cycle. So I can give you an example. Today, what I hear from clients and many is how bad things are out there, which is really ties into what you talk about the recessionary side. Their impact, though, is that a recession hasn't come yet, right? And that the worst is yet to come. Yeah, but what I'm hearing from you is actually this is where the opportunity actually is arising, because the future looks a lot better than the present.
That's exactly it. I mean, if you think about the market returns this year, outside of those 7 stocks in the US, it's been fairly flattish markets, modestly positive to kind of flattish in certain areas, which is not atypical of where we are in the economic cycle, heading into the potential for some economic weakness. Now, again, we have to be careful about how we think about recession. And you said it, everyone's worried about it, and yet unemployment in Canada is sitting at around 5%. In the United States, it's 3.8%. And there is this disconnect. Typically, when unemployment is at these levels, consumer confidence is really high.
Right.
But consumer confidence is actually quite low, and yet unemployment is very, very low. And I think, if anything, it's to what you said, the news cycle, what we're being fed. We're being fed a lot of pessimistic views. And are they completely warranted? Well, we'll see a recession in the numbers, but again, I don't think it'll feel like it, because in Canada, in the United States, and other areas, we're at a labor shortage. We can't find enough workers. So we're already at a deficit for the labor market out there, or the employers that would like to hire. So I don't think we're going to see significant job losses in the potential for any kind of economic contraction in Canada or the US, just because companies can't afford to lose the workers that they might not get back when they're ready to rehire. So, we'll be told, I think, that we're in a recession, but it won't feel like it. Now, what are investors doing, though, as a result of that? Well, they're being perhaps overly cautious, right? And not taking advantage of some of the opportunities that we see out there. Thinking about bonds, for example, where last year was a bad year for bonds. Well, that's because interest rates went from 0 to 4%. when you go from 4 to 4.5, it's not nearly as painful to our portfolios. And in fact, we're reinvesting into a higher fixed income environment that, again, we haven't seen this in 20 years. So there are more reasons, or there are good reasons for investors to be optimistic. And when we think about that, I'm optimistic over the course of the next 12 months. Over the next 12 days, I have no clue what's going to happen, right?
Yeah.
Over the next 12 weeks, same thing, don't know. But the next 12 months, well, yes, I could see from where we are today to 12 months out, improvement on the economic cycle. Yes, the next 6 months we can probably see, a bit of a contraction, but remember, the average recession lasts less than a year. So, if we're looking a year out, you can start to build the case for, yes, we're going to be coming out of economic weakness. The markets are forward-looking indicators. So the markets bottom well before the end of the recession. And that's even if we are going to head into one. So, you can't sit there saying, oh, well, we know we're heading into one, let's be defensive. We might not see one at all. So thinking 12 months out, there are attractive opportunities that, yes, I think investors should be taking advantage of.
Yeah, really well said. Thank you very much. Because, I think that, you talked about, risk to the upside. And a lot of people don't think that. When you're right, when they think of risk, they think of declines, period. And in this day and age, what people are looking at and talking about are things like GICs, which in my opinion is looking in the rearview mirror, because we're looking at what's happened in the recent past and what you can get on a GIC without any understanding about the opportunity cost of that movement, which means, right, the bonds, like you're talking about, the opportunity for capital appreciation, not just the interest that you're earning, plus the global spectrum of these. And again, the risk to the upside for the whole economy improving faster than people think, which, by the way, history has always told me tends to be the case.
Exactly. And on the GIC, it's a question that I get on an ongoing basis about, well, if we're headed towards this type of risk, wouldn't I be better in a GIC? Over the longer term, bonds tend to outperform GICs. And longer term here, I'm saying like 3 years, typically 3 years or longer, a bond portfolio will outperform a GIC because it can take advantage of the change in the interest rate environment, where with a GIC, you're locked in. At the same time, a year ago, Rod, we may have had the same conversation, because a year ago, investors were saying, we've just come through a bear market. Interest rates are at attractive levels. Why don't I just park all my money into a GIC? Well, you could have done that. But since a year ago, we've got the equity markets that are up. And in the case of the United States, up substantially. So we couldn't have predicted the gains, but what we know is what you give up when you lock in your money in a GIC is the opportunity to the upside. Yes, you have no downside, but you give up significant opportunity to the upside. And we see this all the time. Investors tend to sell at the wrong time. They tend to sell at the bottom of the market to go safe, miss the upside, and that's upside you'll never get back. If investors say, well, today I'll buy into the market, you're already up, say in the United States, say 12 to 15%. That's a missed opportunity that you can never get back.
Yeah, that's right. And the majority of our clients are sitting in what I would call moderate or balanced portfolios. And if we were talking about a year and a half or 2 years ago, Philip, and we would have been talking about the news cycle, talking about the death of the balanced portfolio, how fixed income is dead. There is no opportunity, right? And that equities are fully valued, et cetera, et cetera, et cetera, the news cycle. Yet here we are sitting talking about the opportunity, actually, ironically, in that fixed income market. And really what I would call the return of the balanced portfolio, which is more of a pension style management like we are doing, and why it's actually an opportunity for clients today.
Absolutely. I mean, that was it was a funny conversation. And I've heard this, I've been in the business 30 years, and I've heard the death of the 60-40 portfolio, the death of the balanced portfolio numerous times. And I often say, look, the 60-40 portfolio isn't dead. It's just misunderstood. Right? You need to understand it and use it to your advantage and adjust to it, or adjust that positioning over time. And today, for example, we would say, yeah, do I want to be 60-40? Actually, I want to be probably 58-42 or, 55-45. It's something that has worked time and time again because of these cycles that we go through. the equity market cycle, the fixed income cycle, and the two, how they balance each other out over long term. And if we were just to look at, right back to 60/40, historically over a rolling 10-year period, a 60/40 portfolio has less downside than 100% equity portfolio, and actually outperforms 100% equity portfolio 52% of the time. So it's almost 50/50 there, but still, you're not at a disadvantage being in a 60/40 portfolio. It works very well.
That's right. Yeah, I agree. Well, I obviously agree. And one last question, because I could go on for a long time. But I'd like to just quickly say that one of the things that you've been really great at, Philip, is doing your quarterly webcast, right, for all of our clients, right, online. And also, I really want to encourage people that they can join your podcast. Philip, do you want to quickly talk about your podcast?
Yes, and thank you for that, Rod. Really appreciate it. So weekly, myself and my team, we release a podcast. It's a nice short podcast, anywhere between, say, 4 to 6 minutes on what we think is relevant for where we are today. And we'll talk about everything. For example, last week we talked about oil and the impact on the consumer. This week we're going to talk about valuation. But if clients want to stay on top of what we're thinking, and get a perspective on some of the market events, they can find it on whatever podcast platform they listen. And it's called The Living Markets. If you look up IG, The Living Markets, you'll find it there. You can subscribe to it.
Yeah, thank you. We'll share that also in the link when we send it out to the clients, Philip. So again, I don't want to take up too much of your time. A few discussion points that I really will get to next time, maybe not too distant future, but I'd like to talk about private equity and private debt, why it plays an integral role in the marketplace, particularly in this environment, how we've been utilizing this within our portfolios, how it is a competitive advantage to help protect the downside as well as help enhance the upside later. And I'd like to talk to you about the hot word today, or the two initials that everybody wants to talk about. Do you know which ones I mean?
AI.
AI, exactly. Yeah.
That's the artificial intelligence up here working.
Yeah, that's right. Philip, thank you again so much. We'll reach out to you probably again, not too distant future, just to tie into those subject lines, right? And take care. Thank you very much for your time, and keep up the amazing work. Thank you
I
very
look
much.
forward to it, Rod. Thank you for having me.
You're welcome.